Joining us now to discuss, we've got Leslie Falconio. She is the head of taxable fixed income strategy at UBS Global Wealth Management. Leslie, it's great to have you on here. So talk to me about the risk of reinflation here, given what we've seen in the jobs print today. Did the Fed potentially go too far too soon with 50 basis points?
I think, listen, the 50 basis point move, given how restrictive the Fed fund level is to begin with and how high the Fed fund level is, I wouldn't say they went too far. It was definitely preemptive. But I think what we've seen today in terms of the employment report and now having a 3-month average of about 186,000, which is up from about the 114,000 in the last print, just reinsures the market that 50 basis point move on the first cut is not a trend. And I think, as you mentioned earlier, and this is something that we had expected also, is the market's starting to take out those 50 basis points cuts that they had priced in, for possibly November or December. Now, as you mentioned, it's about 6% in November. It's down to about 17% in December. So I think the market is now readjusting to a less dovish outlook, which we believe they should have to begin with. So we're not surprised that they're taking those cuts out. But again, as we know, we have another employment report before the Fed meets. It's going to be very clouded given the hurricane and some of these strikes. And you still have that divergence of what claims are showing and the employment report is showing versus things like JOLTS, where the quits rate's very low, jobs hard to find are difficult, and hiring, although there's not a lot of layoffs, there's not a lot of hiring either in the market.
Leslie, is there a scenario where the Fed stops easing given the fact that the labor market, if we do get another strong print like today's?
I find that to be very unlikely given the level of where we are. And I think that when we talk about the reacceleration of inflation, again, inflation is trending lower. We think that inflation will continue to trend lower. There's no question that you might have these pockets of vulnerability, such as what we're seeing recently in oil. But the question of sustainability and the actual impact that will have over increasing long-term inflation, we really don't think that's the case. We think that, goods inflation has obviously been coming down for quite some time. It may, if that port strike actually lasted longer, that would have been an issue, but that's been resolved. And now we think on the service side, while the service inflation has been sticky, over the long term, we do think it comes down. So you might have these pockets of vulnerability, but we don't think the Fed is going to pull back because of some large inflation reacceleration. And given the level that we're seeing of the real Fed fund rate, to continue on that cut will likely be the path. But again, it's going to be moderate. It's not going to be a consecutive of 50 basis points.
Well, let's talk about the neutral rate, because I'm interested in what we're seeing in zero coupon inflation swaps showing expectations for inflation over the next 12 months are higher than they've been since July. So I'm curious, is something like this telling us that we are underestimating strength in the economy and potentially where the neutral rate might be heading into next year?
Well, listen, finally the neutral rate has gone up. If we look at prior to the employment report in the December 2025 silver contract, you had that contract at about a 287, which isn't far from what the Fed's projected neutral rate will be. Our expectation, we know that neutral is difficult. So, we really don't know what the neutral rate is until you pass it. But our expectation of neutral was around that, still remains around that 3.25, and the market is adjusting up to that. But to your point, I think even if you look at the break-even inflation expectations of, say, 5-year TIPS market, 3.5 weeks ago, that was about a 187. Now we're at about a 215. So you are seeing a rise in inflation expectations, but that's twofold. One, the market is removing the expectation of a hard landing, right? And it's going more to the soft landing. Two, obviously, the 50 basis point cut had the inflation vigilantes a little bit on concern. And number three, we've seen this rise in Brent and WTI, which again, we don't think is necessarily going to be a lasting tailwind to rising inflation.
All right, Leslie Falconio, always great to get your insight. Thanks so much for hopping on with us here this morning. UBS Global Wealth Management, head of taxable fixed income strategy. Thanks so much.